Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, January 5th, 2022, and this is Blockhead Traders Weekly. On this week's episode, we're getting back into the swing of things, and I'm joined by fellow Blockhead trader Viper XL 007. And on this week, we are going to take a look at some futures and options on futures. I'm doing my best to convince Viper to dip his toe into that water. I figure if I'm going to dabble in the crypto pool, he can dabble in the futures option pool a bit. But before we hop to this week's content, I want to give a shout out to our Discord, link in the description below. We stream this episode live every Wednesday into our Discord. We also have a link to thetagang.com/sprocket888. I post each and every one of my trades, the good, the bad, and the ugly. So check those links out below. But let's hop to this week's content. Viper, it has been a crazy time in the market lately. Quite the Santa Claus rally we had coming up into Christmas there, where everything just started getting lifted and every day it was kind of up and up and up. And that's not good for me, the premium seller, because I kind of like those red days to bring that volatility up. And we got a little bit of that at the end of the market today. I don't know if you happened to see, but the S&P, the NASDAQ, everything really started sliding into the close by quite significant percentages. So I don't know if this is the start of potentially some premium selling time, but I've been watching the indexes, and that is where I love to sell premium, especially on futures. So I thought I'd take some time today to try to lure you into the future pool.
Yeah. I hadn't watched today's action too closely because I was still over in crypto land, and today's action was far more exciting in a bad way because you can't do put selling and you can't do short selling and things that capitalize on a big down day like we had today. But I am excited for the potential over in equities land to have that red candle and really get into this proper.
Yeah, so let's hop in and let's start at the very, very beginning about what is a future. Now, futures can be quite complex. They can be quite intimidating, and consider this the beginner's trail, and I'm only going to touch on certain aspects. This is by no means a comprehensive dive into futures, but this should give you a couple of ideas of what the heck a future is and how do the options work in the futures land. So a future is essentially just a time-bound contract whose current price represents what the anticipated value will be of whatever that contract is for at the expiration time. And so futures were originally designed, I believe, for commodity trading, and most of the futures are commodity: grains, cattle, pigs, natural gas, oil, things like that. And what they typically trade is they typically settle into a physical good. So if you trade oil futures, that actually settles into literal barrels of oil. And so, it's a way for people that need to consume those physical goods, producers, manufacturers, to lock in prices at certain levels. So, for example, in oil, there is a monthly expiration cycle. And what that means is if I buy that future today for X dollars, I will receive those barrels of oil at expiration for that price. So it's kind of like an option because there's a time component and it expires, it becomes worthless, but it actually at expiration settles into whatever that underlying actually is. And these types of futures are usually used to hedge positions. So big traders use them to take the opposite weighting hedge to protect their portfolio, to keep it neutral. They're used by large traders that actually want the physical good, that actually want the heads of cattle, or they actually want the bushels of wheat, things like that. So it's how they can lock in those prices. You don't find a lot of retail traders in here for a number of reasons. One of which is the notional value, basically the amount of product that one futures contract represents is huge for a retail trader. The notional value of some of these things will be tens of thousands to hundreds of thousands of dollars. And that's just way too large for a retail trader to get into. Additionally, they're not super accessible. You usually have to go through extra approval steps on your broker in order to be able to even trade futures, because they don't really want the casual investor kind of waltzing in there and kind of losing their shirt because they don't understand something. And in general, most futures have just 4 expiration cycles. They're quarterly expirations. So you have Q1, Q2, Q3, and Q4 futures. Some things like commodities, natural gas, oil, things like that will have more frequent expirations. But you can pretty much count on at least quarterly expirations for those contracts. So Viper, have I scared you here yet with this?
I mean, yeah. This is the intro. I mean, this part is the scary part, that this stuff represents entire heads of cattle and entire barrels of oil. Like, it's, I mean, I realize there's more to understanding it and whatnot, but obviously that's a very concerning aspect of misstepping and having 100 barrels of oil show up at the door, or, I mean, this stuff, that seems like an extreme case, but it also seems like if you really didn't know what you were doing, that's a reality.
Yeah, absolutely. And not to mention, a lot of the stuff in the futures land doesn't necessarily trade on the same fundamentals, right? There's no company behind them. There's no, earnings. There's no market cap. There's supply, there's demand, stuff like that. And so really where this episode is going to go is all these commodities, all these futures and financial stuff, forget about them. Pretend they don't even exist. The important part, and the part that we're going to get to, where I recommend kind of the intro, where you want to step into the pool gently, is there are futures on indexes. And you hear about these every day on CNBC or the Wall Street Journal or Financial Times. They talk about the futures are up today, the futures are down today. The futures market is basically open from Sunday at 6 p.m. and it doesn't close until Friday at 5 p.m. For most futures. They trade all the time. And so what a lot of people will do is, one of the things you can trade is indexes on futures indexes. And they're basically trading the S&P while the S&P is closed. And so that's what these financial people are looking at when they say the futures are down, which means a bunch of people are trading overnight, causing the futures or the price to tick down. And that can usually be an indicator on what's going to happen in the market that particular day. Because remember, a future is what everyone thinks the price is going to be at the expiration cycle of that future. And so the other piece that I don't recommend getting straight into is actually trading futures themselves. There's a whole myriad of reasons of why I don't recommend it, but where I would propose a beginner start would be options on futures. And it's kind of a strange concept to wrap your brain around, because futures expire, options expire. So you're trading options that expire that settle to futures that expire. So it's kind of like a second tier derivative of a derivative product. But the cool thing is, there's nothing special about the options in futures. They behave the exact same way as the options on equities that we talk about all the time. They have the exact same Greek values. They have the delta, the gamma, the theta. They have expiration dates. You have your puts, you have your calls. And so really all of the mechanics that we talk about all the time in equity world completely transfers and carries over into the futures world. So it's essentially the same type of product that you're going to be trading. Now, the one thing that is really goofy, and this is usually what scares a lot of people off, is the pricing is a little different. So when you go into your broker and you check the options put contract and it says 10.00, in the equity world, you would in your head connect that and say, oh, that's $1,000 because it represents 100 shares of whatever the underlying stock is. In futures, the options represent just one futures contract. So it's not 100 futures contracts, it's just one. And the problem with futures, I call it a problem, is they do not have uniform pricing. So every single future has a different dollar amount for its tick value. And each future doesn't always move in the same amount of ticks. So some futures might move by 0.1 ticks. Some futures might move by 0.25. And everyone is different. So what that ends up meaning is when you get into the option pricing, there's no consistency or uniformity there. And so be cognizant of that. And something you can definitely work through. It shows out perfectly fine on the P&L charts in your broker. You can look up what the option price translates into dollars. But here's an example. In the NQ, which is a NASDAQ future, a trade of 10.00 actually yields $200 US. In MNQ, which is the micro NASDAQ futures, it's $20. ES is the S&P. You can see that 10 represents $500. And if you ever saw a 10.00 in natural gas, which you won't see because they don't actually trade with that high of values, that would actually represent $100,000. And so I caution you when you start looking at the option chain, if you see something where you're like, wow, it's going for $30, that's $3,000, it might not be. So check the P&L and make sure you understand that part.
So that, is also, we're definitely getting into the comfort zone. We're away from barrels of oil. We're away from heads of cattle. And we're into options, which, as anyone who's watched our episodes knows, I'm become very comfortable in especially utilizing naked put options. However, this filtering of what is what on price to US dollars, this exists in, for us, obviously Thinkorswim is the platform of choice. So this is easily serviceable. This is easily found what this translation is.
Yeah. So your broker will have usually their platform will automatically translate it into actual dollars before you make the trade.
Okay.
There's the Chicago Board of Options, CBOE. You can go to their website and you can actually get detailed information about all of the option products that are there, the tick values, futures values. Very, very, very good resource to read about that part of it.
Okay. So when you go to put in the order and Thinkorswim opens up the last confirmation box and it tells you your loss risk, your profit potential, all that stuff is pre-translated. So even if you calculated it wrong,
Correct.
You look at that screen and go, whoa, that was not what I was signing up for. Back it up.
Exactly. So your broker will get this all translated and it will be in actual dollars that will impact your actual pocketbook before you execute the trade.
Gotcha.
Like I said, let's move focusing just in on the indexes. What you're going to find is not all futures have options. Most futures do have options. However, an example is the M2K, which is the micro version of the Russell Index. There are no options available on it. I would steer you towards three futures: the ES, which is the S&P futures, the RTY, which is the Russell 2000 futures, and the NASDAQ, which are the futures on the NASDAQ. These are the most liquid, most traded futures and corresponding options. There is a future on the Dow, but I don't recommend trading it. The liquidity is very poor. It's just not a good vehicle to be able to get in and out of. Now, one thing is ES, RTY, and NQ are very large products. And so for some portfolios, they might just be too large to trade. So remember, position sizing. It's very important. Control your risks. So fortunately, both the NASDAQ and the S&P have a micro version. These are 1/10 the size of the parent versions. What that basically means is you can take off bites of those at 1/10 the notional value of the larger contract. And that's the one that I'm going to recommend the very beginners kind of focus on, because you'll see they're much, much more manageable in size, but you still get the same benefit and leverage as you would from a larger contract. And the last important thing I want to call out here is these do not trade any different than what you know on the equities. Like the SPY would be the ETF that tracks the S&P. So if you're used to trading that in equities, it trades the same way with the same price action as MES or ES, the S&P futures options. QQQ most commonly reflects the NASDAQ, and it trades the exact same with the same price action in the futures world of NQ and MNQ. So you can think of it as just different ways to look at the exact same product.
So now we're really getting into the wheelhouse, obviously, with these micros, because like you said, position sizing. And to me, that was another intimidation factor, was the size of what's happening, the size of the ES, the RTY, the NQ, the size of those contracts. And even if you play it fairly, I, again, don't like to use the word safe when we're talking about anything, but fairly risk averse of sorts.
Conservatively.
Yeah, conservatively, it's still, there's always that risk. And so that was a very intimidating factor of just the size of these. Should something go sideways, should another pandemic come on and like all of a sudden plop, like, you know, I mean, stuff like that. So the micros here are incredibly interesting because now I feel like I have control over that risk management, position sizing, and things of that nature.
Exactly. And the next slide, I'm going to start kind of comparing these three trades, or three trades specifically, and show you the difference. And then, you know, we're going to hop into an actual option chain and look at an MES contract and kind of talk through how you might pick some of that. And so, you know, let's take a look at, well, if these are all the same, why are you asking me to step out of my comfort zone and go into this future world? You just told me these are the same thing as the SPY and the QQQ. I love those. I trade them all day. I understand them. Why am I even going to consider futures? And so let's take a look here at three different trades. These are all centered around the S&P index. So I chose 16 Delta. This is 16 Delta as of tonight. I picked the exact same expiration. So these options here, they're at the exact same strike. They have the exact same expiration, and they're all on the exact same index. And what you see here is the SPY, it registers its price 1/10 the actual value of the S&P. So its strike is 435, is a 16 Delta put. And the MES is the micro S&P futures. That's 443.50 strike. And then another 43.50 strike for the ES future. And what I have here is this is the premium that you would collect if you sold this 16 Delta put in each of these three products. For the SPY, you'll collect $346. For MES, you'll collect $166. And for the ES, you collect exactly 10 times more than the MES, because remember, it's exactly 1/10 the size. So you would collect $1662. Now, anybody that sells a naked put, knows you have to put up buying power to secure that trade. And so what I have here, and this is really where the difference starts to come in, is the buying power required to make this trade. To open the trade, this is the buying power you need. So for those SPY contracts, you need to put up $6,234. The MES contract, you need to put up $843. For the ES contract, you need to put up $8,435. So, like I said, this is where position sizing comes in. You can see that this MES position is a little bit more manageable because that buying power need is much lower. Now, I want to point out the risk on all three of these trades is exactly the same, okay? And I'm judging risk by the probability of going in the money. They are all 16 delta puts. The only difference is how much buying power do you expend compared to the premium that you collect. So you have this last column, which is called ROC, or return on capital. So how much money do you get back for the amount of money you have to put up to get that? And with the SPY, you get about a 5.5% return on capital. You can see that in the futures world, you get about 6 times that efficiency, yielding almost 20% return on capital. And you might be like, wait a minute, what's going on here? Because you told me these are all the same. The strikes are all the same. Why don't they have the same capital efficiency? And the reason is because of how margin is calculated and how buying power is calculated. In futures of all types, they use a thing called span margining, SPAN. You can read about it, Google about it, but it is a different way to calculate the amount of money that you need to put up to execute a trade. In the equities world, everybody uses Reg T margin. Your broker probably gave you a big document about Reg T margin, and that is the big difference, is how margin is calculated. So why should you trade options on futures? Because if you're going to be trading the indexes, you will get a lot more capital efficiency out of the futures version of the product. And I would ask that basically you don't necessarily need to go fishing into the futures pool to try to find your trade, right? If you follow price action and you have defined levels on indexes where you're like, hey, this is where I'd be comfortable selling a put on this index. Don't think of futures as any different than the equities when it comes to futures. It's the same thing, just in a different form factor. So it's at that time that I would recommend going to the futures world to say, hey, I want to put a short put on the S&P. How do I do that the most efficiently? Oh, maybe I'll put that on an MES contract instead of a SPY. Let's jump to an S&P chart. All right, so looking at the chart, if you have some sort of predefined concept about different levels on where you think the price action is, this is where you guide yourself to making a particular trade. When you have a level already defined from your own price action research, your own beliefs, and your own momentum. Now, I'm looking at an MES chart here, but I can't stress this enough. You can look at any S&P index chart. It's all the same. It's all the same product. I'm looking at the MES because I want to see the option chain associated with that in a second, but you could have your charts on the SPY. You could have them on the SPX if you wanted. Basically, your price action is the same everywhere. And so, this is starting to come down. Like I mentioned, volatility is starting to tick up a little bit here, which is good. It means the premiums are going to come up. Viper, I don't know if you have an opinion on an S&P level of where you're like, hey, I'm comfortable with this being a level, or where you might pick a strike.
Yeah, I mean, the nice thing here, because we're dealing with indexes, and one of the most liquid things available, which, to me personally kind of ties it into what is so spoiling about charting crypto, is the high liquidity that makes the chart so nice to look at. So looking at the SPY, at the S&P chart here, I personally see a very clear level that I'm comfortable with at 453. And what I see there is historically going back, let's see, what is this? Back to September 1st, we actually tested and failed this level. And then around October 22nd, we passed it. And it's a classic resistance support flip level. And we've bounced support off of it twice. And the steep drop today, I don't see anything that gives me the warm and fuzzies until we get to 453. So let's call it 450.
Okay. All right. So if we jump to the option chain here and you say, when you call it 450, you're comfortable with a short put at 450. That's basically what you're saying, right? Or would you go lower than that? Where would you sell a short put if you know that's a level?
I would go lower and 445.
Okay. Yeah, don't worry about where the actual option pricing comes in because these are so liquid. Just go off of your price action. Don't get scared away by the dollars that you see in here. So if this thing's meeting your volatility target and you have a level in mind and you think, now's a great time to sell, let's go to that level. So 445, we're going to go ahead and sell a short put on 445. Now, this has a bid price of $48.25. And what I'm talking about here when I say that this is not really $4,825, when you come to the P&L chart, so this strike of $44.50 would go ahead and pull in about $241, and it would use about $1,000 in buying power. And what I would like to call out here is as this thing slides on the price slices up here, right? Those of you that have watched position sizing on me know that I like to protect my bailout price for basically twice the credit that I received. So if I'm receiving $241, I'm going to look for where is my loss around $480. And so that's going to be around 43.05. And so I'd set my price slice here at 43.05. And at 43.05, your buying power need for this trade would be 23.48. That would be your buying power expansion if it fell to about there. Now, hold this in your mind, Viper, and let's take a look at the same trade on the SPY. So we're short the 445 and 43.05 is our bailout. So let's take a look at the P&L chart here. And you can see that we would be collecting $472, which is more credit than the other one, but your buying power is going to be $7,500. So let's go ahead and set our double the loss that we would normally set for kind of that bailout. So we're collecting about 472. So we're going to look for $940 loss for our bailout price. That $940 loss is going to come somewhere around 430. So I'd set this to 430. And should you get to your bailout price, buying power needed is almost $11,000. And this, Viper, is why I believe you should strongly consider trading in the futures world.
Yeah, that is a stark difference. And so that difference, that must represent risk or something like, so what you're saying from previous slides you had was that difference is purely just based on how the margin requirement is calculated for each of these. Is that correct?
100%.
I would say extremely efficient.
And I want to emphasize that the buying power consumption does not represent risk. I can't say this enough. The risk is exactly the same when it comes to the price movement. You're selling the exact same probability on the exact same product that's moving the exact same prices. So the real difference is what I called out in that last slide is its capital efficiency.
Yeah. So let's talk about one other angle then of why this buying power impact could be so important, and that would be the phrase you've mentioned to me in the past of buying power expansion. Is it safe to assume then? So now we're dealing with this 7x gap between these two. That should things start to go sideways one way or another, it seems to me like the SPY trade there, you're going to run into a pretty sticky buying power expansion situation depending on the size of your account much faster than you would on the futures trade.
Yeah, that's exactly what will happen. And keep in mind, both of them, there's no such thing as preventing buying power expansion when you trade naked options. It's a fact of life. And what drives buying power expansion is margin needed to secure the trade. And because margin is calculated differently between futures and equities, that's why the buying power expansion will consume more of your capital in the equities market versus the futures market. You need to protect for it in both because it's absolutely going to happen to your trade. And that's exactly why when I set my position sizing, I move those price slices down to where I say this is my tolerance of pain, and I look at the buying power needed at that point, and that's what I reserve in my head on my account. And so I basically, in that SPY trade, it was almost $11,000. And so if I were to make that SPY trade, I would set aside $11,000 so that I knew that I had it if that buying power were to expand.
Yeah.
And it's capital efficiency because in the futures, I have the exact same risk. I go down to a similar strike, and that buying power expansion is much less because margin is calculated differently. That is futures and options, a beginner's look. Hopefully, I can convince Viper to dip his toes in here. And really, I want you guys to just focus on the indexes. Ignore the rest of the futures. Don't touch commodities. Don't touch herds of cattle, bushels of wheat. Just forget about them. They're there. They're cool to look at, but stick with what you know. And the indexes are what people know, and they translate.
Yeah, I mean, I can say for sure. I mean, today's S&P dip of 1.89% was one of the biggest retraces recently. So I'm definitely going to have my eyes on that. And combination of, like we did live here, the price level, real good, like, good from my comfort zone and whatnot of what makes a good price level. So yeah, I'm going to keep an eye on this and maybe start 2022 with a little futures action.
This days like today, I absolutely love. The Russell is one of my favorite indexes to play. Volatility always tends to be a bit higher on there. My personal preference is if the volatility on the index on the future is over 20%, that's when I'm going to start considering it. If it's under 20% volatility, that's not historic volatility, that's actual implied volatility. As long as it's over that, I'll start to consider it. And when you get into the 30s, if you get into the 30s, the S&P rarely gets into the 30s. But if it does, that's a cue for me to go. So a lot of times 25 is a real sweet spot. I would highly, highly encourage, because what you really play when you get into those higher implied volatilities is not only do you get the bigger premium, but these are indexes, okay? These things are not picking up 10% in a day, dropping 15% in a day. They will never have the volatility of a Roblox or a Tesla or something like that. And so when you get into the 25s and 30s, there is a very high likelihood that you're going to have a reversion to the mean, which is usually a much lower value. So you get not only a ton of theta burned off, but you get some serious volatility contraction. Well, hopefully I've sparked a little bit of curiosity in Viper as well as you guys out there to know that there are different ways to trade the same thing, and some of them can work to your advantage and give you a little bit of a leg up. Remember, futures are not something that a lot of retail traders deal with. And so looking into just the index aspect of it, that could be an edge for you and your portfolio. If you're going to be trading the indexes anyway, why not do it in the most efficient way to leverage the most out of your capital as possible? So keep an eye on it out there. Hop into the Discord like we mentioned earlier. Let us know if you have any questions. Leave a comment below, things you'd like to hear about, more about futures you want to know, questions you run into. More than happy to dive into them. Otherwise, good luck out there. Good luck trading. And remember, think outside the block.